Okay, guys, so good morning, and we're going to look at the S&P 500 US stock market index in today's markets. And we're going to talk about why we are maintaining a long bias towards buying the stock market and why we are expecting this strong rally to continue in the United States, because the long-term outlook for growth is becoming more positive. And when you have positive growth in the US, as we did for 10 years since 2009's financial crash in the US, the stock market was rallying higher because every year that GDP is expanding is because the companies within the United States are earning higher amounts of profit and they're expanding and growing as a company. So gross domestic product, GDP, is a total value of everything produced within a country. So if you've got the 500 biggest companies growing every single year, so earning more money than the previous year, then all of those, the value of all the goods they're producing is growing year on year. And then the markets are buying these stocks every single year in anticipation that the value of these stocks will continuously go higher. And that's why you have a situation where for 10 years, you have a very strong bullish stock market because growth continues to be positive year after year in the United States. So we understand manufacturing PMI is the key economic indicator markets pay attention to because it predicts GDP growth with an 85% certainty. So if you go over to our ISM tab on our endogenous spreadsheet, looking at the US economy, I have showed you this spreadsheet on many different occasions. What we can see is that when manufacturing is above the level of 50 and growing, this indicates there's going to be growth in the US economy. So highlighted in blue is the manufacturing PMI and highlighted in red is GDP. So as you can see, when the manufacturing PMI is above the level of 50 and growing, you have positive prints of GDP highlighted in red. When manufacturing PMI is below the level of 50 and contracting, indicating negative levels of growth, you get negative prints of US GDP. So, of course, if we're above the level of 50 and growing, then we're expecting growth in the US economy. And this has an 85% certainty in predicting GDP over the next 12 months, going back to 1948. So, our latest reading for the manufacturing PMI in the United States, the latest reading was 60.7 and is growing. Clearly, it's been growing since we was contracting, then it's gone back above the level of 50, and we're moving strongly above the level of 50. So if manufacturing is predicting growth in GDP, as we can clearly see here, then we know that the markets, therefore, will be buying the S&P 500 in anticipation of stronger growth in the United States. And here's an example of how this actually works. So let's just say that from 1950, I'm going to give an example. The S&P 500 went from 1784 to 19 points and 53, and GDP expanded from 2,147 billion to 2,230 billion. So GDP was positive over one quarter, over 3 months, and then the S&P 500 moved up before the GDP data was released. So what the markets are always doing is they're pricing in the expectation of growth. And in that situation, you have a 1-1 score. And you can see that the markets are predicting this 56.89% of the time. They're getting this right in terms of buying the S&P 500 over 3 months, and then GDP is reported positive. So you can almost say that the S&P 500 is a leading economic indicator that the markets use to price in the expectations of stronger growth in the US. Because if they're expecting the companies within the S&P 500 to be earning higher profits, then they're going to buy the share price now. So then when it rises, they make a profit, and then GDP actually is reported to be positive, and the markets are therefore buying the S&P 500 every quarter in anticipation of stronger growth. The 0-0 situation is when you have markets selling the S&P 500 and then GDP is reported negatively. And then you get the 0-1 situation is when markets are profit taking on previous positions, then GDP is actually positive and the trend continues, and they only get it wrong 8% of the time where they actually are buying the S&P 500 and GDP is negative. So what I'm basically trying to say to you is that markets get this right 62% of the time. And this is why when we're looking at the ISM data and the S&P 500, I'm not sure why it won't load, but basically they move hand in hand with each other. So at the moment, because the manufacturing data is pointing towards positive growth. You have a situation where the markets are betting that the company should be earning higher profits in the next 12 months, even though the US economy is getting battered now. It's what they're expecting in the near-term future for why they're buying the stock market index. So this is explaining why the markets are buying the index now. And it's not just manufacturing data, because manufacturing does make up 20% of the economy, but you have the non-manufacturing data, which is the services PMI. This makes up 80% of the US economy. And again, look how strongly correlated this is to positive and negative GDP when you have above level of 50 and below the level of 50. And at the moment, the non-manufacturing PMI is also currently above the level 50 and growing. So manufacturing, which makes up 20% of the US economy, the services data makes up 80%, is both pointing towards growth in the US economy. The consumer sentiment is pointing towards growth. Now, remember, if consumers are confident, if the sentiment of consumers are confident, they're going to spend money now and save less. If they're not really confident about their future, they're going to spend less and save more. But at the moment, they're expecting the reading of around 81 is predicted for around a 2% GDP growth. And you can see here how strongly correlated the two are. You can see the consumer sentiment highlighted in blue and GDP highlighted in red. You can clearly see how closely they move each other. This is literally predicting whether consumers are going to spend money. And if they're spending money, then you know the S&P 500 should be going higher, because that's how companies are going to earn their profits. So at the moment, consumer sentiment's positive. You've got manufacturing and services PMI positive, hence why we have a long bias towards buying the S&P 500. So that's our long bias at the moment. That's why I have been buying this stock market for quite a while, and I'll continue to be holding this trade, because just remember, guys, the fundamental reason why the stock market was going higher. Let me take this over to a weekly chart so there's just less candles. The fundamental reason why the US stock market was bullish for 10 years, because GDP growth was continuously growing over that 10-year period coming out of the financial crash. The US economy was growing every single year until there was a first recession this year when the pandemic hit. So obviously markets didn't expect companies to be earning profits as aggressively as before, and that's why we got our large sell-off. But we're now back in the cycle where we started after 2009, so we should expect this to continue as long as the US can continuously grow, and the fundamental monetary and fiscal policy has been set to achieve this. Low interest rates, huge fiscal spending. Joe Biden's government going to pump around $2 trillion into the US economy. You have the central bank with basically unlimited quantitative easing coming into the US, and that's going to support the US economy to grow. And that's why we have a long bias towards the S&P 500. So, of course, as the trend continues, I'll be adding further buy positions. But this explains, guys, why we have to have a long bias towards the S&P 500. So, I hope that makes sense. And that's just my short analysis. Thank you.